Thank you very much for that introduction, Stig, and thank you for inviting me to speak at this year's FinTech Week. My name is Robert Karlsson. I'm the head of banking and finance at Magnusson Law, and I have a background at the Swedish financial regulator. I will today give you a brief presentation of the new guidelines from the European Banking Authority on loan origination. We have about 15 minutes for today's presentation, so I will keep it on an overview, and I will start with a background and giving you the objectives behind the guidelines. I will then move into the scope of application, which I mean what companies have to comply with these guidelines. After that, I will give you the key aspects of the guidelines, and I will end with a brief discussion of the implementation schedules of these guidelines, meaning when do companies have to comply with these guidelines. As for the background, these guidelines are a response to an action plan adopted in 2017 by the European Union. The aim of those guidelines was to tackle the high level of non-performing loans in Europe. These guidelines are preceded by two other guidelines from 2018. Those guidelines dealt primarily with loans that are already non-performing. The guidelines we're going to talk about today, they have as an aim to prevent loans from going bad in the future. And that is very much the main goal of these guidelines. So more specifically, they aim to improve companies' credit governance. They aim to ensure that companies have a prudent risk management, and in the end, that credits originated going forward are of high credit quality. So as you can see, there is a clear financial stability objective behind these guidelines. They also have a consumer protection aspect. So they introduce the concept of fair treatment of consumers, which, among other things, means that companies have to consider consumer interest not only in the credit assessment stage of the loan, but also in their credit policies, in their credit granting criteria, as well as in the design of the loan product. So in that way, they very much resemble other product governance rules that have been implemented on the financial markets the last couple of years, for example, for financial instruments and insurances. As for the scope of application, so the guidelines in full applies to all banks, credit market companies, and certain investment firms. For other type of borrowers, for example, consumer mortgage institutions, consumer credit institutions, and really any borrower that any lender that lends money to consumers, they have to apply Section 5 of the guidelines. And Section 5 of the guidelines concerns how to do credit assessments of your borrowers. And at this stage, it could also be noted that there is an option in these guidelines for national regulators to actually extend the guidelines and apply Section 6 and 7, pricing of loans and valuation of property, also to these type of lenders. But as far as I know, there is no indication that that will be the case in Sweden. This slide I just want to very briefly touch on, and it's to show that not all loan products are in scope of the guidelines. So, for example, debt instruments such as a bond, they're clearly out of scope of the guidelines. Section 5 and 6, credit assessments and pricing, do not apply to certain type of borrowers. So, for example, if the borrower is a financial institution, or a public sector entity, those sections of the guidelines does not apply. And then the key aspects of these guidelines. So the guidelines consists of 5 main parts. There's one part regarding internal governance, one part regarding credit assessments. There's pricing, valuation of collateral, and monitoring of borrowers' collateral and credit risk. And while we today, as I indicated, we will only be able to kind of scratch the surface of these guidelines, I hope to give you at least some of the key aspects of these various sections. And let's start with the internal governance section. So this part of the guidelines contain very quite comprehensive and detailed requirements for the governance of credit, of credit risk, of credit granting. Not only including policies and procedures, but also including a remuneration system you have, as well as how you manage your conflicts of interest. This section also sets out fairly express expectations of the management of the lenders to set a prudent risk culture, risk strategy, risk appetite, and also adopt an adequate internal control system to manage credit risk. In this section, we also have a section that specifically deals with automated models for credit assessment and credit decision makings. And here, there's a pretty clear signal from the regulator that companies that use these type of automated models, they need to fully understand how the models function, that the output is what is expected from the models, and you also have to ongoingly assure that the quality is what you expect the quality to be of these models. And finally, as most legislation these days, the guidelines instruct companies to specifically consider risks associated with ESG factors and risks associated with fraud, money laundering, and terrorist financing. Moving on into the credit assessment section. So this is a section that quite specifically, in a detailed way, instructs lenders what documents do you have to collect from your borrowers, how do you have to document that, and how do you have to carry out your credit assessment. And this section is divided into several parts depending on what type of borrower the company has. So you have a part for consumers, you have a part for micro and small businesses, medium-sized and large businesses, as well as several parts for more specific loan products or loan situations, for example, for shipping finance, project finance, real estate finance, and real estate development finance. So my view is that this part of the guideline goes much further than anything we have had in Sweden before. So it's a very specific instructions of the information you need to bring in on your borrowers and how you should assess that information. In addition to that, or maybe rather as part of your credit assessment, lenders also have to carry out sensitivity analysis of their borrowers. And that is to ensure that the borrowers will be able to repay the loans even if things goes bad in the future. So you have to test the repayment capacity in negative future scenarios. Moving from there, we go into the sections dealing with pricing of loans and valuation of collateral. So the pricing of loans, here is a I would say a supervisory expectation to price your loans based on a risk-based model. This section contains a number of elements that companies, lenders should consider when they price their loans. There's also indications in the guidelines that you should most likely have different pricing frameworks depending on what type of loans you give and what type of borrowers you have in your business. But maybe most interesting in this part is that here the regulator quite clearly, I would say, points out that these rules are not supposed to prescribe a specific way to price your loans. The pricing of loans is still going to be a business decision for the companies going forward. These are more elements that you have considered when you are pricing your loans. And collateral valuation, well, that's pretty much what it sounds like. It's rules, quite detailed rules for how you should value property that you have as security for your loan. It's both for movable and immovable property. And it sets out instructions for valuation before you give the loan, valuation ongoingly based on your monitoring of the collateral and your credit exposure. And this section furthermore sets out several criteria for companies when they use internal or external valuers or for their use of statistical models. And last, but definitely not least, Section 8, which deals on monitoring. Comprehensive rules for ongoing monitoring of your borrowers, the collateral that you have, and the lender's credit exposure. This is supposed to be made, for example, by requiring regular credit reviews of certain borrowers. The guidelines say for at least for medium-sized and large enterprises. The guidelines also introduces requirements for the use of qualitative and quantitative early warning indicators to put borrowers possibly on a warning list. So I believe that most likely Section 8 with the ongoing monitoring is the part of the guideline that will cause most challenges for companies to actually implement in their current operations. And that is indeed reflected also in the implementation schedule that the regulator has given the companies. So these guidelines, they were published last summer, 2020. They enter into force on June 30, 2021. At that date, the guidelines will apply to all loans that are originated, issued after that date. 1 year from then, June 30, 2022, Section 5 enters into force to any existing loans, meaning any loans that the lender has already provided already before today. Under the provided that such loans are renegotiated in a specific way outlined in the guidelines. And then finally, about 3 years from now, in June 2024, there's a deadline. And by that deadline, lenders will have to have collected all the information and all the data that they need to comply with their monitoring obligations in Section 8 of the guidelines. So the regulator has here clearly realized quite rightly, I believe, that companies will today not have all the data, all the information they need to monitor in compliance with the guidelines, and has then set a a 3-year period to gather all that information, and by June 30, 2024, the entire guidelines in full are in force, and the companies have to comply with them in full. That was my very brief overview of EBA's new guidelines. I thank you very much. I hope this brought you at least gave you a flavor of the complexity of these guidelines. And as we all know, many companies already work with the implementation of these ones for a very strict deadline of this upcoming summer. Thank you very much. I'm very happy to have been invited here, and I hope you have a good rest of this seminar.